The pound dollar reached a new 2-year low today upon falling beneath the 1.19 support yet again, the second time since last week. These lows are due in part to US dollar strength after Friday's strong non-farm payroll data revealed over 100,000 more new US jobs than were expected. As traders anxiously await Wednesday's new CPI numbers, anticipation for red-hot US inflation grows. However, much of the pound dollar's bearish momentum is due to the pound itself and unusual pessimistic circumstances that the UK's economy is facing. Let's explore what these conditions are as we issue a warning. How doomed is GBP? Interested in supporting our content? The A1 Trading YouTube channel has just introduced channel memberships. To become a member, click join next to the subscribe button. This is a monthly reoccurring payment that lets us continue to produce this kind of content for you. Along with becoming a member, you'll get a badge next to your name during our live streams, along with cool emotes that only members can use. We are currently working on lots of other projects for channel members exclusively, so stay tuned for those. Thank you to everyone who has already become a member, and we look forward to making new content for you. On July 7th, a Thursday morning, UK Prime Minister Boris Johnson resigned as leader of the Conservative Party. His stepping down came amid an unexpected mass resignation of over 50 Conservative members of Parliament due to disappointment in party leadership over a slew of scandals. It is worth noting that while Johnson has resigned as head of his party, he intends to remain Prime Minister over the next few months, until the governing Conservative Party elects a new leader to replace him. These events have aided throwing Parliament into disarray and will certainly not improve its economic problem-solving efficiency nor any sentiment adjacent to it. While political resignations of this magnitude would be inconvenient for any country to experience, this is especially difficult for the UK since post-Brexit trade deals are still either in their infancy or have yet to be negotiated. Since 2020, when Brexit took effect and the UK's trade to GDP ratio declined by 8.31% from 63.4% to 55.09%, trade statistics have been volatile and tricky to analyze, especially in light of post-COVID supply chain issues. According to the UK's Office for National Statistics, quote, "It continues to be difficult to assess the extent to which trade movements reflect short-term trade disruption or long-term supply chain adjustments." The UK's annual inflation rate hit a staggering 9.1% in May, the highest among the G7 countries. In theory, this should be bullish for GBP, because higher inflation implies a growing economy and serves as an antecedent to rate hikes, which are central bank attempts to stabilize prices. However, despite the Bank of England, the UK central bank, warning that inflation could reach 11% in the coming months, they lag significantly behind the US Federal Reserve in terms of hawkish aggression. They have thus far only resorted to 25 basis point rate hikes within the past year, with their target interest rate currently at 1.25%. This slow pace is nearly as tepid as tightening monetary policy can be. The hesitancy to stamp out UK's hyperinflation is extremely bearish for GBP. The UK's unemployment rate recently ticked up to 3.8%. While rising unemployment is a bad sign for the performance of a country's economy, this is particularly problematic for the UK and the Bank of England for two reasons. First, considering that the Bank of England's target interest rate is a relatively low 1.25%, while inflation is at 40-year highs, for unemployment to already be increasing is discouraging. This indicates fragility in the UK's labor market, and by extension, their economy, which likely contributes to the Bank of England being wary of contradictory monetary policy. Second, if the UK labor market continues to be acutely sensitive to the cooling economy, this joblessness might especially aid in slowing consumer spending, reducing the overall need for the Bank of England intervention via rate hikes, unless stagflation surfaces. According to recent COT data, GBP clocks in at the third most shorted COT asset, with 70.75% of all institutional traders selling the pound. This bearishness is a significant factor in creating GBP selling pressure, since much of the Forex price action is generated by institutional activity due to the sheer scale of their purchases and sales. For now, Fundamentals for GBP appear rather bleak despite high inflation, and COT data reflects this. However, there is a chance that this hyperinflation in the UK could eventually force the Bank of England's hand, prompting them to eventually lean into hawkishness to prevent catastrophic overheating. While this pivot could be around the corner, along with newfound GBP bullish momentum, traders would be wise to assume that this is the case until there are clear signs from the Bank of England. Unless this happens, GBP seems primed for continued selling. While the pound dollar has received a strong sell signal from the Edge Finder, an A1 trading tool for supplemental trading analysis, there are many GBP pairs potentially worth trading too. Pairs such as GBP CAD, which likewise receives a strong sell signal, as well as GBP AUD and GBP NZD, which both receive sell signals. Along with GBP USD, these 4 pairs all rank in the Edge Finder's top 8 pairs worth selling. Now, some key takeaways. Pound dollar hit a 2-year low intraday as selling pressure continues. UK leadership continues to be in disarray following Prime Minister Boris Johnson's resignation as the head of the governing Conservative Party amid mass MP resignations. This does not bode well for the UK economy or post-Brexit trade negotiation developments. Despite the UK's annual inflation reaching 9.1%, the highest among the G7 countries, the Bank of England continues to implement 25 basis point rate hikes at crawling pace. The UK's unemployment rate recently reached 3.8%, despite lukewarm Bank of England hawkishness, showcasing a fragile economy which may prompt further Bank of England caution. GBP remains the third most shorted COT asset, with 70.75% of all institutional traders selling the currency. This bearishness aids in guaranteeing GBP selling pressure. Unless we see the Bank of England distinctively pivot towards aggressive hawkishness, the chances of their bullish reversal look slim. For those interested in shorting GBP, GBP USD, GBP CAD, GBP AUD, and GBP NZD appear to be 4 of the 8 pairs most worth selling according to the Edge Finder.